Let's talk about the main prediction of the capital asset pricing model. And the main prediction is that investors earn a return proportional to the total portion of market risk that they choose to hold. The more of the market's risk they choose to hold, the higher the return. The less of the market's risk they choose to hold, the lower the return. And the market risk is a function of the economy. It's just how much risk there is in our economy. And so the more of it you hold, the more you earn. The less of it you hold, the less you earn. Remember, for now we have two kinds of risk. We have market risk and idiosyncratic risk, and the point is that you're compensated for the market risk, you're not compensated for the idiosyncratic risk. So let's talk about why that is. Market risk is the risk incurred by all stocks, and it varies across stocks. It's a function of the cyclicality of the company, steel versus soap, for example. So in a good year or a bad year, people don't buy more or less soap. But in a good year, they buy a lot more steel, and in a bad year, they buy a lot less steel. Idiosyncratic risk is the risk incurred by just that individual company. And here's the point. Idiosyncratic risk can be eliminated through diversification, and diversification is free. And since you can, for free, get rid of a huge portion of risk, and other people will do it, you are not compensated for that level of risk. Market risk cannot be eliminated through diversification, and that's why you must incur it, and therefore this is why you are compensated for it. So let's talk about the difference between idiosyncratic and market risk. Let's consider Amazon and MGen. Amazon is a general retailer. There's lots of sort of cloud and web stuff too, but let's just think about the retail side. And maybe this isn't a great example in this year, sort of given the COVID move to online retail, but I'm still going to use this as an example. So if the market is up, Amazon is up because it's a general retailer, and if the market is down, Amazon is down, again, because it's a general retailer. It's more cyclical than, say, a discount retailer like Walmart, but it's probably less cyclical than like a luxury retailer. Amgen makes drugs, so likely not so cyclical. In a good year or a bad year, people likely buy the same amount of medicine. But there's a lot of idiosyncratic risk associated with a drug maker. So if a drug trial is successful, the company does really, really well. And if a drug trial is not successful, the company likely does poorly. So holding just Amgen in a portfolio means that I would incur a small amount of market risk, but a large amount of idiosyncratic risk. And so the total risk from holding Amgen would be high. It would be those two components, both the market risk and the idiosyncratic component. So what about diversification? What if instead of holding just Amgen, I hold a portfolio of many pharmaceutical companies? Now, if one of the companies in my portfolio has an unsuccessful drug trial, another company in my portfolio of many, many pharmaceutical companies might have a successful drug trial. The idea is that the idiosyncratic risk of these individual companies will be offset by holding them in a portfolio. And therefore, a portfolio of drug companies will mitigate or eliminate the idiosyncratic risk and leave only the market risk. And we saw this before mathematically. If these idiosyncratic risks are not perfectly positively correlated, and by definition, idiosyncratic risks are not, then diversification lowers risk. So if I can hold a stock in such a way that it has less risk, our basic principle of risk aversion means I'm willing to earn a lower return from holding it. So how do I earn a lower return from holding a stock? If a stock is available and I'm willing to earn less from holding it, how do I do that? And the answer is I pay more. So here's a fundamental principle and sort of the way to think about expected return going forward. The expected return of a stock, some stock I, over this next time period, from time 0 to time 1, is a function of a couple of things. The first is the price of the stock right now. What am I willing to pay for it? And the price of the stock at time 1. So there's also dividends. We'll ignore those for now. So if I look at my equation, it's the return that I'm going to earn from holding the stock over this time period is a function of what I think the price will be at time 1, which is what the future earnings are going to be and any sort of realization of outcomes at time 1, divided by the current price. But note that the only thing in this equation that's current is time 0. So how much do I expect to earn over the time period? Well, it's a function of how much I'm willing to pay now, plus how much I think it'll be worth at the end. So here's the idea. The value of the stock in a year is completely independent of whether I own it or not. If I buy the stock or don't buy the stock, it'll still be worth $50 in a year, regardless of what I do. And it'll be worth $50 in a year as a function of what happens over this next year and prospects going forward. And I have some expectation about that price. I expect it to be $50. But if investors determine a required expected return over this time period, they set the price at time zero in order to earn that amount. So if it is the case that the current price is too high and therefore the return is too low, then no one buys the stock or people offer to sell it and the current price goes down. And so if the return going forward is too low, then the current price goes down so that people can earn more over the next period. Or if for a given expected price at time one, if the expected return is too high because the price is too low, then the stock becomes very attractive and then people buy the stock, increasing the price. So let's just recap this. To earn more in the future, if I need to earn more in the future than the stock is currently paying, then people don't buy it or they sell it and the price goes down. So a current price decrease increases future forward-looking return. And if I'm willing to earn less in the future, then I buy it and the price goes up. So to earn less in the future, the current price increases. To earn more in the future, the current price decreases at time zero right now.